You glance at the clock, the hands crawling toward noon, and you know the market won't wait. The charts glow faintly on your laptop, indicators blinking like tiny signals in a controlled chaos. Emails and work tasks pile in the background, and somewhere in the recesses of your mind, the thought creeps in. I can squeeze in a trade during lunch. It feels efficient, clever even, to use your midday break to try to catch a move while the office hums around you. But beneath that optimism lies a hidden danger. Your mind isn't operating at full capacity, and neither is your trading edge. You log into your trading platform, eyes darting between charts and the clock, heart rate a notch higher than usual. 10 minutes, 15, maybe 20, that is all the time you have. There is no luxury of patience here. Every tick feels urgent, every candle a potential opportunity or threat. Your pre-lunch plan is clear in theory. Identify setups, execute with precision, respect your risk management. But in practice, your mental resources are already taxed. Your focus is split, your cognitive load is high, and your decision-making muscles are fatigued from the workday grind. This is the first crack in the armor. As soon as the trade idea emerges, impulsivity slips in. You hesitate, then rush. You tweak your entry because the clock is ticking, ignore subtle context cues, or increase position size because you feel you need a bigger payoff in a shorter window. These are small decisions, seemingly inconsequential, yet in the compressed environment of a lunch break, small errors magnify. Science confirms what you feel. Decision fatigue reduces the function of your prefrontal cortex, the part of your brain responsible for rational thinking and impulse control. Cortisol levels spike under pressure, emotional reactivity increases, and your natural caution is overridden by urgency. You are, almost unknowingly, primed to overtrade. The first trade executes, and for a moment, there is a flicker of satisfaction. But the market doesn't pause. It shifts, spins against your position, and suddenly the margin for error disappears. You adjust your stop loss slightly because surely it will bounce back, rationalizing that a few pips here or there won't matter. These are the exact moments when lunch break trading exposes your weakness. Short sessions amplify emotional responses and encourage deviation from disciplined strategy. What should be a calculated, measured decision now becomes reactive and instinct-driven. The account is at risk not because of the market itself, but because your mental state is misaligned with the demands of trading. You glance at the clock again. 10 minutes left, and your impatience builds. Frustration and subtle panic creep in, mixing with the desire to make something happen before the bell rings on your break. This is FOMO in its purest, compressed form, the fear of missing a move, coupled with the illusion that action equals achievement. Psychological research supports this. Under time pressure, humans exhibit heightened risk-taking behaviors, ignore stop-loss rules, and prioritize immediate outcomes over long-term success. You feel compelled to engage, to force trades that don't align with your system, simply because the opportunity seems fleeting. And then comes the second trade, fueled by leftover tension from work and the frustration of the first trade moving against you. It's smaller, faster, but still irrational. The trading journal entries from past sessions now read like a predictable pattern. Lunch break, trades skewed toward impulsivity, violations of rules, and higher than normal losses. It isn't the market conspiring against you. It is your environment, your timing, and your brain's response to stress that creates this perfect storm. Trading within a constrained period, with half a mind on deadlines and reports, erodes the discipline that trading success depends on. By the time your break ends, you close positions hastily. Maybe you've made a small profit, maybe a loss, but either way, the mental toll is significant. Your prefrontal cortex is taxed, your emotional bandwidth is depleted, and your confidence in executing future trades is subtly undermined. You return to your desk, juggling emails, meetings, and reports, unaware that the psychological residue of these rushed trades lingers. Over time, these repeated episodes accumulate into patterns of overtrading, impulsivity, and inconsistent results, the very mistakes that destroy accounts for part-time traders. This isn't speculation, it is a consistent theme observed in behavioral finance and trading psychology. Decision fatigue, cognitive overload, and stress-induced emotional responses combine to create an environment where even seasoned traders struggle. Trading during lunch, a window intended for convenience, becomes a trap precisely because it compresses risk, stress, and decision-making into a short, high-pressure interval. The outcome is predictable. The more you try to force trading into artificial time constraints, the more your results will deviate from your strategy and edge. Recognizing this pattern is critical. Part-time traders, especially those balancing a demanding 9 to 5, must respect the limitations of both their mental and emotional capacity. Lunch break trading isn't inherently wrong. The danger lies in ignoring how stress, time pressure, and mental fatigue compromise decision-making. Each impulsive trade taken under these conditions is a microcosm of larger trading failures, rule violations, emotional trading, and risk mismanagement. Understanding this connection between environment, psychology, and execution is the first step in transforming part-time trading into a controlled, disciplined practice. As you step away from the charts and return to your workday, the lesson becomes clear. The battle isn't just on the charts, it is within yourself. Trading requires attention, patience, and emotional stability, all of which are compromised in rushed sessions. The lunch break, once seen as an opportunity, now reveals its hidden cost. It erodes discipline, encourages impulsive decisions, and ultimately works against consistent profitability. By recognizing the trap, you can begin to restructure your approach to trading, aligning your schedule and mindset with the conditions that support long-term success rather than short-term convenience. As you return to the charts during your midday break, the reasons behind lunch trading mistakes become clearer. It isn't just the short window that creates pressure, it's the combination of emotional, situational, and cognitive triggers converging at the worst possible moment. Understanding why these trades fail requires dissecting how your mind reacts under stress, how external pressures amplify your impulses, and how internal narratives convince you to override rules you normally follow without question. Emotion is the silent saboteur. After a morning filled with meetings, emails, or back-to-back deadlines, your brain is carrying the residue of frustration, irritability, and the subtle weight of underperformance. The market, indifferent to your office struggles, doesn't pause for your emotional baggage. When you step into a trading session, even a short one, these emotions bleed into decision-making. You feel an unconscious urge to compensate, to make up for the time lost in work or the trades you missed while focused on professional obligations. Frustration manifests as impatience, as small losses feel magnified, and even minor price fluctuations trigger overreactions. Your emotional state subtly, almost invisibly, warps risk perception. A setup that would normally feel routine now carries exaggerated stakes, and the instinct to act impulsively increases dramatically. Situational triggers compound the emotional impact. A lunch break is, by nature, constrained. 10 to 30 minutes may be all you have to identify setups, enter trades, and manage risk. The clock ticks relentlessly, pushing you to make decisions that would normally be measured and deliberate. Long commutes, pressing deadlines, or pending meetings outside your trading window further exacerbate the stress. Even environmental factors like a noisy office, inadequate space, or a constantly ringing phone reduce focus and increase cognitive load. These situational pressures create a fertile ground for mistakes, compressing decision-making into an artificial pressure cooker where rational analysis gives way to reactionary impulses. Then come the cognitive traps. These are the self-deceptions your mind invents to justify actions it shouldn't take. Thoughts like "I can take just one trade," "I can still focus for a few minutes," or "I deserve to make a win" seem logical in the moment, but are exactly the narratives that lead to impulsive errors. Cognitive psychology teaches us that under time pressure and mental fatigue, humans tend to overestimate their capacity for attention and underestimate risk. Your brain convinces you that compressed conditions are equivalent to normal trading circumstances, when in reality, every second of indecision or emotion-driven reaction compounds risk. This is why lunch break trades often violate rules that otherwise feel ironclad during your focused morning sessions or dedicated trading periods. Analyzing past trades reinforces these patterns. Reviewing your trading journal from weeks of midday trading often reveals consistent themes. Entries that are rushed, stop-loss adjustments justified by hope, position sizes inflated to chase quick gains, and exits dictated by impatience rather than plan. By cross-referencing these trades with notes on your workday stress, cognitive fatigue, and emotional state, the correlation becomes undeniable. Lunch break trading is uniquely prone to errors because the timing, combined with mental depletion and emotional triggers, creates a perfect storm. It isn't lack of knowledge or technical skill. It is the alignment of mind, body, and environment against optimal execution. Physiological factors cannot be ignored. Decision fatigue, elevated cortisol, and reduced prefrontal cortex activity all converge in the midday trader. You may feel alert, but your executive function's critical thinking, risk assessment, impulse control are impaired. You misinterpret market signals, hesitate on clean entries, or second-guess stops. The compressed time frame forces action when patience would normally dictate waiting. Studies in neuroscience show that even brief periods of fatigue significantly impair risk evaluation, making your lunchtime impulses disproportionately costly. The market doesn't punish. Your mental state amplifies minor errors into significant losses. Behavioral patterns emerge consistently. Traders attempting to squeeze trades into a lunch break often demonstrate compulsive efficiency. They see the market as a task to complete rather than a probabilistic game. Every candle is an opportunity to reclaim perceived lost time or missed profits. This mindset drives overtrading and a subtle shift away from rules-based behavior. You rationalize violations. I only have 15 minutes, so I'll bend the rules just this once. The cumulative effect over weeks is erosion of discipline, increased variance in results, and ultimately, diminished confidence in your ability to execute under normal conditions. What starts as a pragmatic approach to multitasking morphs into a structural weakness in your trading framework. Even minor lapses carry outsized consequences. A slightly delayed stop loss, a larger position than usual, or chasing a breakout can compound in the compressed lunch window. Because decisions are rushed, feedback loops are short and emotional, not analytical. You might book a small win, but the mental toll persists. A loss, however minor, triggers frustration and an urge to recoup quickly. This emotional residue carries over into the remainder of your workday, affecting mood, concentration, and future decision-making both at work and in subsequent trading sessions. It is subtle, insidious, and cumulative. Recognizing these triggers is the first step to mitigation. Emotional, situational, and cognitive factors each play a role in lunch trading failures, but they are interconnected. Awareness allows for intervention. Emotional awareness enables you to pause and reset. Understanding situational pressures helps you restructure your trading environment or session timing. Cognitive traps can be preemptively neutralized with rules, checklists, and accountability. By dissecting the mechanisms of failure, the lunchtime trap transforms from an invisible, recurring risk into a predictable, manageable scenario. Ultimately, the takeaway is clear. Trading during a lunch break is not inherently doomed, but the convergence of fatigue, stress, and time pressure creates a situation where even disciplined traders are at risk. Recognizing why this happens emotionally, situationally, and cognitively gives you the insight to create interventions, rules, and routines that protect your account, your mental state, and your long-term consistency. The failures aren't caused by the market, but by the environment and mindset you bring to it. Once this is understood, the path to disciplined, predictable trading even within a part-time schedule becomes achievable. Avoiding lunch break trading mistakes starts with shifting the mindset from reactive urgency to deliberate preparation. The first step is acknowledging that your environment and mental state dictate performance more than the market itself. When your trading window is narrow, it's tempting to rush setups, force entries, and chase quick wins, but consistent results come from controlling the controllables, your process, your energy, and your rules. Establishing reset rituals before even touching the charts transforms a rushed, stress-driven session into a disciplined, high-quality trading period. Reset rituals can be simple but powerful. A 5-minute pause between tasks at work and opening your trading platform gives your mind a moment to detach from office stress. Breathing exercises or short meditative practices reduce cortisol levels, calm the sympathetic nervous system, and prime your executive functions. Physical movement, even a brief walk to get water or stretch, improves blood flow and mental clarity. Journaling prior to trading, writing down your mental state, intentions for the session, and top setups to watch, creates structure and reduces impulsivity. These rituals signal to your brain that you are entering a different cognitive mode, from employee to trader, and they create a mental buffer between the pressures of work and the market. Next comes the discipline of rules. For lunch break trading, it's critical to define parameters that prevent emotional overrides. Setting a maximum number of trades per session eliminates the compulsion to chase perceived opportunities. A pre-trade checklist entry criteria, stop-loss placement, risk per trade, and exit strategy ensures that no trade occurs without objective validation. Stop-loss discipline becomes non-negotiable. Because the time frame is short, it's tempting to nudge stops or justify exits with hope, but adherence to your predefined levels maintains risk control. Rules aren't arbitrary restrictions, they are scaffolding that allows your mind to operate efficiently under compressed conditions. Time management in this context is about quality over quantity. A 15-minute lunch break is not a full trading session, and trying to squeeze in multiple trades is a high-probability path to mistakes. Instead, identify A-plus setups trades that align perfectly with your criteria and ignore the rest. Waiting for the ideal conditions teaches patience, even in constrained periods. It's a shift from activity-based thinking, where you feel compelled to do something, to probability-based thinking, where every trade has a clear edge. This approach preserves capital, reduces stress, and reinforces the mental discipline that carries over to full trading sessions outside the office. A practical system for transitioning from work to trader mode can be condensed into a 30-minute routine tailored to your schedule. Spend the first 10 minutes on reset rituals. Step away from your desk, take deep breaths, stretch, and jot down mental notes. The next 10 minutes are for reviewing charts, identifying setups, and setting alerts. The final 10 minutes focus on execution, entries, stop-loss placements, and monitoring trade progress. Even if your lunch break is shorter, adapting this sequence ensures each action is deliberate and reduces the likelihood of rash decisions. It's not about trading more, it's about trading smarter. Environmental control is equally important. Trading from a noisy break room, crowded cafeteria, or desk surrounded by distractions is a recipe for errors. If possible, find a quiet corner, Use headphones to block out noise, and set up your charts in a way that highlights only essential information. Minimalism in chart setup reduces cognitive load, allowing you to focus on high-probability setups. Every extraneous alert, indicator, or color scheme is a potential distraction that can push you toward impulsive actions when under time pressure. Accountability mechanisms further strengthen this framework. If you have a mentor, trading group, or even a disciplined colleague, share your plan for lunch break sessions. Knowing someone will review your trades creates an external layer of discipline. This is particularly effective when combined with journaling. Document every decision, your mental state, any deviations from rules, and lessons learned. Reviewing this data weekly reveals patterns that might otherwise go unnoticed, such as tendencies to overtrade after stressful mornings or deviations from stop-loss discipline under tight time constraints. Emotional self-awareness is another pillar. Recognizing the subtle signs of frustration, impatience, or anxiety before and during lunch trading can prevent reactive behavior. If you notice rising tension or compulsive urges, step back. It's better to skip a trade than to force action under emotional influence. Over time, this practice cultivates a resilient mindset, allowing you to maintain discipline even when work pressures encroach on trading windows. Emotional regulation becomes not just a reactive skill, but a proactive one, embedded into your routine. Finally, leverage the principle of microsessions. Even if a lunch break is short, splitting your focus into micro checkpoints, reviewing charts at predetermined times, setting alerts for entries, and using automated notifications enables structured observation without the need for constant screen monitoring. You maintain presence in the market, protect mental energy, and avoid compulsive screen time. This approach ensures that even small windows can be used efficiently without compromising risk management or discipline. By integrating these strategies, reset rituals, defined rules, time management, environmental control, accountability, emotional self-awareness, and micro-session structure, you transform lunch break trading from a high-risk, low-reward activity into a disciplined, predictable session. It's not about forcing action in compressed time. It's about leveraging focused, high-quality execution to preserve capital, protect your mindset, and maintain consistency. The short time frame no longer dictates chaos, but becomes a controlled, intentional practice that supports long-term trading growth, even while balancing a demanding 9 to 5 schedule. Building a sustainable trading routine begins with understanding energy, not time, as the true currency of consistent results. For 9 to 5 traders, trading windows are constrained, and the natural instinct is to prioritize the clock over cognitive readiness. The problem is, decision quality is dictated by focus, not by whether the lunch bell rings or the commute ends. Establishing energy-based sessions allows you to trade when your mind and body are capable of disciplined execution rather than reacting to exhaustion or stress. One effective approach is to map your personal energy cycles throughout the day. Even within a structured 9 to 5, there are natural peaks and valleys. Morning hours may provide high cognitive function, midday can be sluggish, and late afternoon might bring a second wind. Identifying these windows informs when to engage with the markets, when to review setups, and when to step away. For lunch break trading, this means acknowledging that if your energy is low, no trade is worth compromising your rules. Energy-aware scheduling prevents forced trades and reduces emotional reactivity that can quickly erode both capital and confidence. Creating a predictable pre-trade routine reinforces this energy-based approach. Small, Consistent rituals prime your mind for trading and signal a cognitive shift from work to market focus. This might include a brief walk to reset circulation, deep breathing to lower stress hormones, reviewing a predefined watch list of setups, and journaling your mental state before touching the charts. These steps condition your brain to enter trader mode efficiently, even when available time is short. Over weeks, these rituals transition from conscious actions into automatic behavior, reducing friction between intention and execution. Another cornerstone is procedural discipline. Maximum trades per session, strict adherence to stop-loss placement, and pre-trade checklists protect against impulsive decisions. By codifying these rules, you create guardrails that operate independently of fluctuating emotions or workday fatigue. Over time, these procedures become habitual, turning discipline into a default mode. This is particularly critical in part-time trading where external stressors, emails, calls, deadlines compete for attention and create cognitive noise. Clear processes preserve mental bandwidth for high-quality decision-making. Integration of micro-reflection moments is equally important. Even brief pauses during a lunch break session can help recalibrate focus. After a trade or when monitoring a position, stepping away for 60 seconds to observe breathing, body tension, and mental clarity allows for real-time emotional regulation. These micro-reflections act as early warning systems for frustration, impatience, or overconfidence. When recognized early, they prevent impulsive interventions that would otherwise compromise a trade. Over time, these small pauses cultivate heightened awareness, the foundation for consistent performance under pressure. Environmental consistency supports these routines. Trading from the same location, with minimized distractions and a streamlined chart setup, reduces cognitive load. This allows attention to remain on high-probability setups rather than peripheral stimuli. Consistency also extends to technology. Alert systems, chart layouts, and risk management tools should be familiar, intuitive, and reliable. The brain spends less energy adapting to the environment, freeing capacity for strategic observation and execution. In part-time trading, every bit of cognitive efficiency counts. Long-term benefits of an energy-aligned, disciplined routine extend beyond immediate profit or loss. Regularly trading in a state of focus builds confidence, reduces stress, and strengthens emotional resilience. You learn to respond to the market with clarity rather than reactivity, and you reinforce a mental framework that prioritizes process over outcome. This shift transforms trading from a reactive, high-pressure task into a predictable, repeatable practice where mistakes become manageable and wins compound strategically. Accountability remains a critical component. Sharing your routines, plans, and results with a mentor, community, or even self-review journal ensures that deviations are noticeable and actionable. Reviewing trades alongside emotional states highlights patterns invisible in isolated reflection. For example, you might notice that after a particularly stressful morning meeting, your tendency to overtrade increases. Recognizing these patterns allows for preemptive intervention, such as delaying trading or shortening sessions. Accountability converts insight into behavioral adjustments, closing the gap between knowledge and execution. Finally, the closing principle is the integration of patience. Limited trading windows create pressure to act, but impatience is the enemy of consistent execution. Waiting for the perfect setup, adhering to your rules, and accepting that some opportunities will pass without action is the mark of professional discipline. Success in part-time trading is not defined by quantity of trades, but by the quality of decisions made within the time and energy constraints you have. When patience is consistently applied, even small sessions produce compounding long-term results, reinforcing both capital growth and psychological resilience. Mastering this approach separates part-time traders from the majority who treat lunch breaks and evening windows as frantic, reactive exercises. By focusing on energy, structured routines, micro-reflection, environmental control, procedural discipline, accountability, and patience, you create a trading ecosystem that consistently supports high-quality decision-making. You shift the paradigm from chasing the market to mastering yourself within the market's rhythm. This alignment is the hidden advantage of part-time traders who achieve sustainable profitability. The takeaway is clear. Treat each trading session, no matter how brief, with deliberate structure. Protect your energy, follow rules, and prioritize quality over quantity. Make rituals, checklists, and pauses non-negotiable. Build systems that reinforce discipline automatically. Document, review, and adjust based on patterns you observe in yourself. Over time, these actions compound into consistency, confidence, and control. You are no longer dependent on luck or adrenaline to guide trades. You trade with clarity, focus, and precision, even while balancing a demanding 9-to-5 job. Master this one approach, and you will separate yourself from 90% of part-time traders. Start implementing structured, energy-based routines today. Track your mental and physical readiness before each session, adhere to your rules without compromise, and focus on quality trades over quantity. As you refine your processes and cultivate patience, you'll see not just improved trading results, but a transformation in how you approach risk, decision-making, and personal discipline. This is the edge that allows 9-to-5 traders to protect capital, reduce stress, and achieve consistent, long-term profitability.